Prudential of Japan was once a cornerstone of the group's Asian ambitions. By February 2026, it had become the source of a $1 billion drag on the entire group. Regulators and internal reviews uncovered severe compliance failures. Employees had engaged in what the company itself describes as inappropriate investment solicitations. The response was a voluntary 90-day suspension of all new sales. That suspension was supposed to be temporary. It was extended by a further 180 days after management concluded the subsidiary was still not ready to restart. New sales at Prudential of Japan are now shut down until late 2026. The company estimates total revenue loss and remediation costs at roughly $1 billion. What no public filing has yet explained is the internal culture or oversight gap that allowed this to reach that scale. The nature of the inappropriate solicitations has not been detailed. Andrew Sullivan, who became chief executive in March 2025, has been running 5 rounds of Newark layoffs: 57 jobs in July, 63 in September, 63 in November, 54 in March, and now a further 53 on 17 July. Each wave is small against a global workforce of 36,000. Cumulatively, they confirm a restructuring that has been running quietly for nearly a year. Sullivan's chief financial officer told investors that operating expenses are deliberately higher in the short term, framing it as a bet on technology and enhanced service delivery. The cost-benefit, she said, is expected to show up in 2027. The hidden assumption in that framing: the $1 billion estimate is the ceiling, not a floor. If the misconduct is systemic rather than isolated, the remediation costs could continue past 2026. Nothing in the filings rules out the second scenario. On 4 June, a South China Morning Post report triggered something unexpected. HSBC fell more than 5% in London. Standard Chartered dropped as much as 7%. AIA slid 6.8% in its worst session since March. Prudential declined more than 8%. The catalyst? Reports that Hong Kong banks are restricting mainland Chinese clients from opening investment accounts intended for overseas deployment. Beijing has been cracking down on illegal cross-border capital flows. Its securities regulator imposed more than $330 million in combined fines on 3 online brokers operating on the mainland without a license last month. HSBC has now asked mainland clients to sign declarations confirming their funds originate from overseas, not from China. Hang Seng Bank issued a similar form. Bank of China Hong Kong began asking clients to clarify fund sources. The Hong Kong Monetary Authority asked licensed banks to tighten controls on new trading account openings. This matters directly to Prudential's revenue model in a way that the bank sell-off does not fully explain. Prudential relies significantly on mainland Chinese visitors traveling to Hong Kong to purchase insurance products. That visitor policyholder channel is exactly what Beijing's crackdown threatens. If a mainland resident cannot move capital offshore into a Hong Kong investment account, the pathway to a Prudential insurance product is narrowed. The scope of the restriction is still undefined. The South China Morning Post report cited 1 branch suspension. Whether it broadens across all account types and all banks remains unresolved. The second-order question for Prudential is not just the volume of new sales from this channel. It is the bancassurance growth rate. In 2025, Prudential's bancassurance new business profit grew 27% to $1.03 billion, the fastest segment in the group. That 27% growth assumed open cross-border distribution. If HK account restrictions tighten, the assumption underpinning that growth rate no longer holds. Prudential announced a $1.2 billion share buyback program running from January to December 2026. The board framed it as evidence of balance sheet strength and confidence in long-term growth. Chief Executive Anil Wadhwani described the move as reflecting steady progress in executing strategy. On the same day that framing circulated, shares fell more than 2% in London. Then, when the HK account curb report landed 2 days later, they fell another 8%. The buyback structure is worth examining. Of the $1.2 billion, $500 million represents recurring capital returns. The remaining $700 million comes from net proceeds of the ICICI Prudential Asset Management IPO completed in December 2025. That distinction matters. $700 million of the headline buyback is a one-time distribution of IPO proceeds, not an ongoing expression of excess operating cash. Prudential has committed to returning more than $5 billion to shareholders between 2024 and 2027. The $1 billion Japan drag sits inside that same envelope. Bulls holding this stock treat the buyback as proof the balance sheet is strong enough to absorb the Japan loss and still return capital. Bears treat the Japan $1 billion as a figure that has not been stress tested against a prolonged sales suspension. The buried assumption on the bull side, the $1 billion is the total exposure. The bears' buried assumption, the distribution model into Japan and now into Hong Kong, carries structural risk that cannot be resolved by capital allocation decisions made in London. Prudential's 2025 results showed 12% growth in new business profit, 13 of 19 markets growing. The double-digit growth trajectory guidance for 2026 was issued before the HK account restriction report emerged. If bancassurance, the 27% growth segment, is the transmission channel for the HK curbs, and if the Japan sales ban runs into late 2026, then two of Prudential's largest growth levers are simultaneously constrained. The December 2026 buyback completion date is now a monitoring checkpoint. If management accelerates buyback pace through the second half despite Japan and HK headwinds, it signals the balance sheet read is the correct one. If the pace slows or the program is paused, it confirms the bear view. The specific number to track is whether bancassurance new business profit in the first half of 2026 grows above or below the 2025 baseline of 27%. That number, when it arrives, will tell holders which buried assumption the market was pricing. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.